Hey folks, welcome to the show. Sharad, Twitter is now X. What are your thoughts?
Yeah, I saw that. It's a changed already, no, right? Have you heard about the story of X though? Like it's a long fascination that Musk had with X. He wanted to rename PayPal as X PayPal also back in the day, things like that.
I think one of his earlier companies, yeah, and I think his kid's name also is an X. So there's definitely something going around there. Last week we had a super interesting chat around a debt relief platform. So obviously there we were looking at things from a borrower standpoint. But today we are looking at again fixed income as an asset class, but more from a investment perspective. It gives me great pleasure to welcome Saurav Ghosh, co-founder at Jiraaf. Jiraaf with a J. Hey Saurav, how's it going, man?
Going well, Nikhil and Sharad. Good to meet you guys and be on this show.
Obviously, Jiraaf is super fascinating. You guys are democratizing alternate asset classes, namely fixed income, which is something which is not doesn't have the kind of depth within the retail ecosystem. And I guess that's where your platform comes. Would be great to get an initial sense of what exactly the offering here is, and say if I'm a Giraffe customer, what kind of a ride am I in for?
Yeah, so Nikhil, our offering is very, very simple. What we do is we offer access to what we call as fixed income opportunities to individual investors. The way we define fixed income, at least on our platform, Giraffe, is anything that gives you a fixed return over a fixed period of time. Right? That's how we define fixed income. We believe as Giraffe that fixed income is a very powerful asset class for short to medium term investments. If I have a 5-year, 10-year view of my money, I would rather myself invest that money in equities because equity markets is very stable over the long run. But obviously, there's a lot of volatility when it comes to short-term to medium-term investments in equity markets. And hence, fixed income, that's where the asset class comes in, is really, really powerful for short to medium-term investments. So what we do on Giraffe is we offer fixed income opportunities which are less than 3 years in tenure. Right. Okay. And there's a lot of diversity in our offering. So we offer products right from 30 days in tenure going up to 3 years. The idea is to enable individual investors create a fixed income portfolio, and creating a portfolio, means that you need to have a lot of diversity. So 30 days to 3 years in tenure, we offer yields between 6% going all the way up to 18, 19%.
Right.
And anything in this band is what a Giraffe offering is all about. Right. And as I mentioned, all of our products will have a common theme that it will offer fixed returns over a fixed period of time. Right. So we keep that simple. So you might earn 12% in 1 year, 14% in 2 years, let's say 10% in 90 days, right? So whatever it is, but you will know when you make your investment that I will get this much percentage of return in this time horizon. So there is a lot of predictability and certainty to the future cash flows of your investment.
When it comes to fixed income or credit in general, it's the less sexy part, right? At least from a retail lens. It's probably more cerebral and more technical, but it's the less sexy part. And if I think of as a retail investor, the first things that come to my mind are, things like some government securities, corporate bonds, fixed deposits, and pretty much that, right? What is the challenge?
Maybe even debt mutual funds.
Maybe, yeah, of course, debt mutual funds, yes. If what is the challenge you saw as a retail investor? Effectively, these products are out there, right? But what were the gaps in the journey which you thought something like Giraffe could fix?
So I think, we basically saw 3 critical challenges, right? And 2 of them Giraffe will fix, and I'll talk about the third one as well. The first challenge was actually to create products, which are inherently attractive for individual investors. If you see the landscape of fixed income products, all the ones that you mentioned, whether it's fixed deposits, public provident funds, debt mutual funds, corporate bonds and papers, which are publicly available, all of these have a common, I would say, theme again, which is they offer very low yields, right? Barely inflation beating returns in the country.
Right.
And typically, if you now go into corporate bonds, which is the larger fixed income category across the globe, In India, the most publicly available corporate bonds will give you 6, 7, 8% return, but you'll also have to invest over 5-year, 10-year, 15-year period, right? Mm-hmm. Now that's barely beating inflation. So fundamentally, for me as an individual investor, that product itself is not attractive. So the first problem statement for us to solve was that how do we actually bring fundamentally attractive opportunities for individual investors, where then for them it can be a meaningful part of their overall financial portfolio, right? So that was point one. The second thing is that now that we are in the fixed income category right now. All the traditional products are catering only to the lowest end of the risk spectrum, right? Which is your, as I mentioned, 5, 6, 7%. So it's either you're parking it fixed deposit with a bank or you're doing like AAA rated papers. So it's the lowest end of the risk spectrum. So our idea was that can we widen this spectrum where we leave the choice to individual investors, where with an additional delta risk, you can earn a delta return, right? And then all individual investors are, I would say, free to invest basis their risk appetite, basis their financial goals that they want to meet. And if we can do that, probably investors can also earn maybe a double-digit return, 10, 11, 12% through a fixed income product, which is then very close to, I would say, at least on a pre-tax basis, what equity as an instrument or equity mutual fund will give you over the long period of time.
Got it. So you're pushing the risk envelope a bit, and effectively, but are you like a market maker or a distributor of sorts of those products? Like they're out there, companies are issuing securities of a certain nature, of a shorter tenure and a higher kind of IRR return, or are you also involved in actually being like an originator of sorts, like actually sitting down with issuers, structuring these products, and then having some sort of an exclusive right to distribute them through your platform? Because I mean, when I think of Jiraaf, and when you kind of mentioned all these things, I also think of companies like say a Grip Invest or a Bonds Card or India Bonds, where you do get, maybe not in India Bonds and Bonds Card, that's probably more listed in larger companies, but in Grip Invest, you'll definitely find, shorter tenure products, which are probably pushing like 12, 13, 14% in IRR terms.
Yeah, so we do that. So and again, why do we actually focus on origination? So when we bring opportunities on our platform, every opportunity is unique to us. That means we have met these companies.
So you have an exclusive arrangement with them.
Yeah, we're all exclusive. So we meet these companies. We do the structuring. We do the credit assessment. We'll do the due diligences. We have an internal investment committee which finally approves transactions that get live on our platform, right? So it's I would say a lot of rigorous assessment and diligence time that we take and effort that we put in to ensure that we are, opening up opportunities which are friendly for retail investors, even from a risk perspective. Right. See, finally, we are a platform where individual investors are participating, right? So what is the right kind of risk that we can expose them to is very critical to our decision making. And we spend a lot of time, on that aspect while, thinking about doing any transaction, as Giraafs, right? So that's a very cornerstone of our.
When you talk about origination, right? When you talk about 30 days and so on, like one of the biggest things that we see that comes up is probably working capital financing. Right? It seems like a pain point for so many businesses in the country. And is that sort of a key piece of overall borrowers who are sort of trying to fund working capital and are looking to sort of raise short-term debt, and hence it sort of there's a match between what your investors want as well.
So the reason working capital is one of the key products that we have. So we have two key products. One is, I would say, corporate debt, where we take balance sheet position with companies, and then the second is supply chain financing, which is like working capital financing for companies. Right? These are the two key products. About each of them are like 40% of our overall, I would say, exposure as Jiraaf. And balance, we do multiple other products, which put together is about 20%, right? So working capital, as you can see, is a key part of our overall portfolio. The reason we do working capital finance is too, on the investor side is actually it's unique as a sense because, company needs money for 30, 60, 90 days, right? Yeah. And because you're solving that need, that means as an investor, you are able to invest in a use case for 30, 60, 90 days. So in that sense, it works well for the company and for individual investors. I think it's a great product to invest your liquid funds or funds which are just lying in your bank account and you really don't have a use case, right? So it works very well from both sides. The second is genuinely we are solving a very big credit need in the country, right? The MSME SME ecosystem is a large market to tap into. So obviously there is a lot of potential to actually grow and solve that as an alternate capital provider, in the credit ecosystem. So it works well for both, and hence it's a key focus.
And most of this sort of investments, like I guess they are sort of unsecured. Like, I mean, maybe there's some invoice-backed funding as well, but I suspect most of them are sort of basically unsecured and cash to based underwriting.
Yeah, absolutely. So all supply chain financing products, I would say 95% of them. So they are definitely unsecured in the sense that they are cash flow backed, but there is no hard collateral. In some cases, we do take personal guarantees and corporate guarantees, etc. But again, these are softer collateral, and there'll not be any hard collateral associated with it.
Uh, Interesting, like you mentioned that, in the origination part. Now, obviously, when you're originating, there is some level of, soft or hard underwriting exercise that you yourself are doing, right? And one is obviously to look at it more like as a boutique setup. You do a soft underwriting, but then, you kind of syndicate the transaction. And the other is that you're actually providing some financing on the table as well. Do you also like buy these bonds, warehouse it on your books, and then sell it in the secondary market? Do you do that? Or do you take balance sheet risk yourself, or is it more of a marketplace or a matching principle which applies here?
Right. No, so here we do the underwriting, right? So that means, the way we work is when we go and tell a company that, hey, here is our term sheet for, let's say, 10 crores, right?
Yeah.
That means that it is also Jiraaf's commitment to ensure that the company is getting that 10 crore on the committed date, right?
Sure.
So for whatever reason, let's say we are not able to find a demand through Jiraaf as a platform, still we need to uphold that commitment, because, that's how we build our trust and brand even in the corporate ecosystem, right? If I commit and then shy away, that's not going to work, right? So we actually take balance sheet risk in that sense. So we actually commit capital upfront from our balance sheet, and then whether we are able to find demand through Jiraaf as a platform is our headache. It's not the company's headache, and hence that's why So yes, we do take that risk. What we don't do is finally we will downsell 100% of our exposure. So we don't keep any residual portion as our skin in the game. That is at the moment. Going forward, because we are early in our capital journey as well. When as a startup, we'll have a little bit more balance sheet strength. We will be able to participate through our own skin in the game, till maturity, right? So that's the idea.
Right.
How difficult is it to sort of do? It's pretty interesting, right? And one of the issues that often people have is these are sort of smallish companies, unrated. How difficult is it to sort of actually do the due diligence and even assess corporate governance, right? Sort of actually figure that out, and authenticity of numbers. And it's not an easy process, right, when you're doing it at scale. So is there some tech involved in there, or is it sort of just your ability to actually identify companies which have real cash flow problems, and that's about it?
No, it's a bit of both. I think if you are a capital provider in the country, and if you put a front page ad in the newspaper that I'm here to provide capital, you will have a 10-kilometer line outside of your office, right? So I don't think anyone can identify. I would say that like who is a good counterparty in that sense. It's more about the diligence as well, right? So it has both aspects, which is tech and then obviously our experience. Right, and everything that we do. So a part of the tech is basically there is a lot of data which is there in the public ecosystem. Obviously the need is to actually tap into all of those I would say data points, and then create your own intel in some sense, right? So you'll and for here we use a lot of tech integration. So just reading, for example, what is out there in the media, let's say was there in through your Googles, right? So that is one part of it. The second is registrar of companies, ROC. There's a lot of filing that all companies do on an annual basis. So there's a lot of data that you get from their balance sheet, annual statements to charges, which is effectively encumbrance or charge. Technically, when you take a debt or any kind of liability, you'll file that with the ROC. The third is all your legal databases. Right, all your high courts, your courts, they also make filings which are digital today. So there is a lot of, I would say, publicly, and there are few more, right? So there are a lot of today your bureau scores, right, your civil bills, etc. Right, so those are also standard. So there are about at least something, there are a lot of publicly available data. What we do is we use a lot of tech to read all of this data, accumulated, collated, so that it comes in our format the way we like to, I would say, interpret the data, and that's how the output is thrown, right? So in that sense, at least the basic easy stuff is very quick, and we don't need to, I would spend a lot of time in doing that. The second part,
So just one thing, like a lot of this data, right, is digital in nature, but it's probably scanned photographs of filings, right? Is it hard to sort of digest that data using only tech? Like it probably. So how do you sort of because I don't know if there's a PD scanners are available which can interpret, but I don't know if that technology.
No, we don't do that actually. So so this is one part of it, right? So here there will be someone from our credit and risk team who actually goes through each of this collated data point, right? What it helps to do is, someone doesn't need to go to these 6 places, actually key in, find out whether it's available or not available. So the collation part is really smooth and simple. It comes as a single docket. There is a manual intervention today required to kind of read it. We are obviously trying to build and I would say use better technology to kind of do that more seamlessly. The second bit is, then when we take a lot of data from the company that we work with, so they'll share us their bank account statements, all of their documents, their MISs. We kind of then match what we get from public systems to whatever the MISs, that they share us. So we know broadly, how the numbers are looking. The second thing is, for example, once they send us all of their bank statements, we actually digitize the cash. So we actually map cash flows on a month-on-month basis. So if you, for example, give me 5 bank account statements for the last financial year, we will draw out your cash flows, which is inflows and credits and debits, and then kind of see whether it overlays with your MIS, whether it overlays with your financial statement. So that's one part of it, right? So this is all that comes, I would say, more from our understanding and experience. And then the third part and the most important critical pillar for us is reference checks, right? So we do reference checks from, we will definitely go meet the founder. We will definitely go meet, we will do a site inspection at their warehouse or their stores, depending on the nature of the business. We will talk to people down the line, at the shop floor, at the warehouse, and, we get a sense of that. Once we meet the founder, we get a sense of obviously his personality, his thought process, which becomes very critical. And then, most of the company that we work with, they are already banking with some financial institution, whether it's a bank or NBFC. So we will definitely go and talk to that specific RM who handles the account. We will go and take a reference check from there, some vendor contractor who works with them. And obviously, if it's like in the new age economy, then we'll definitely talk to their equity investor, which might be a VC fund, etc. Right? But all of this 100% needs to happen for us to build comfort on corporate governance, on a lot of things, right? Also, you get to understand a lot of corporate governance from soft aspects like who the auditor is, also the way they account few of the entries, right? Like a typical thing in the tech ecosystem, you'll notice is to capitalize tech costs. It is done to show better EBITDA, lower losses, etc. Right? But that's, I would say, is again just then, you're trying to, I would say, downplay what the actual this thing, right? So a lot of these thought processes become clear from a more nuanced data points, and which is where what we focus on. That's why I said it's a lot to do with obviously data available, technology, and our own experience and process.
Sort of like this segment is fairly untapped, right? And that's why it's attractive also. But on the other end, I mean, when it comes to Indian debt markets, probably that point is not just valid to this segment; it's valid to most of the ecosystem. As an investor, am I expected to like hold these instrumental maturity, or is there some sort of a liquidity event I can get? I mean, what is there like? Is there like a marketplace angle there which is worth pursuing? Because you guys are anyways doing exclusive deals here, right? And how do you kind of view that, and how do you think it's changing?
So it's a very interesting question. So I think, what we would love to solve for is, today we see it's a chicken and egg problem, right? So without participation in fixed income, with limited participation, the secondary market.
Primary has to be there, then only that will come.
Primary has to be big, then there can be a secondary market, right? And the even in the public bond markets, right, where the AAA, AA rated issuance is happening, even though volumes are big, you see there is no liquidity. Why? Because 90% of the subscribers are your insurance agencies, pension funds, large banks who are holding everything to maturity. So they are not sellers. And if there are no sellers, there is no secondary market, right?
Yeah.
So that's the challenge with us. So now our first step is to create, I would say, enough participation in primary. Then, I think the liquidity and the secondary markets will evolve, right? So today, that is a key reason why we focus on short to medium term investments, because we know there is no liquidity as an option. Right. So we know that you don't want to lock in your money for 5 years. So we might as well give you options which are, shorter in 10 or 1 year, 2 years. So you can keep rotating and reinvesting if required. At least you're not locked in. Right. So that's one part of it. The second is from a liquidity perspective, as you mentioned, yes, there's a possibility to create a market, but there are also a lot of, I would say we need to find the right structure to do that, because one is the regulatory part, right? Today, SEBI or other regulators can view you as a stock exchange if you start, doing market making in private markets as well, right? So one is that aspect. For that we engage with regulators to see obviously what is the best path to getting that done. The second is also capital, right? If am I the one who's providing liquidity, or am I only market making, right? If I am the one providing liquidity, my ALM and my assets and liabilities need to then be taken into account. So there are multiple perspectives to this. But I think the first step and the first problem for us to solve is to create the primary market. Once that is operating at scale, I think, then there's a genuine need to actually then solve for the secondary market, which we will do. And we have a lot of thoughts over there, but I think it's just a more step-by-step approach.
Right. What is the average ticket size on both sides from an investor standpoint and from a loan disbursement standpoint?
So from a loan disbursal standpoint, we typically like to work with companies where we are giving sanctions anywhere between, I would say, 25 to 50 odd crores. Okay. And the idea is to, we don't do that in a single tranche. We try to disburse that over maybe 2-3 tranches. So, we build up to that exposure. The second bit is on the investor side, our minimum investment on a platform is 1 lakh rupees. The reason is that we felt, our products are still, I would say, exotic. They are not well understood by the larger market out there. So we want to first invest our time and energy and also a lot of education and awareness. And until then, these products are not suitable for first-time investors or people who are not that financially aware. Hence, our minimum ticket size is 1 lakh. Typically, we see that people take about a 10 lakh rupee exposure with Jiraaf over a period of time. That period of time can be 3 months, 4 months, 6 months, but that's typically that's our average, I would say, exposure for a customer on our platform.
Right. Yeah, and let's say a user is putting 1 lakh on the platform. Is that mapped entirely to one deal or one sort of loan, or is that sort of also broken down across the portfolio multiple? I mean, there are two kinds of portfolio risk that you can manage, right? One is sort of pool and diversify into multiple underwriting, multiple loans, but also is each transaction also sort of divided into different pieces of the loan?
So you are taking exposure with one corporate counterparty, right? Now, there are diversification nuances there also. So, for example, if you're giving to an NBFC, that NBFC might have a diversified underlying pool. When you do an invoice, it's not one counterparty invoice that you're discounting. You might also participate in 10, right? So, the way we structure it is you take exposure with one particular counterparty. There'll be a diversified pool, may not be there with the underlying. That will have a reflection on the overall risk score in that sense of the particular opportunity, right? But now it's one-to-one mapping from a counterparty perspective. What we are working on is actually creating these mini mutual funds and mini portfolios so that you can actually invest in a diversified counterparty pool itself, right? Which is what we are working on here, and we are moving towards in that direction.
You mentioned that most of these instruments are either unsecured or quasi-secured, or how does recourse work here, or have you seen that yet, in the sense that when defaults happen, if they do, and when they do effectively? Because I mean, I used to find it quite I think it was grip only, like, which earlier used to have this SPV structure where they would put furniture on that SPV and then lease it out and raise financing against it, and then the guys would always say that we have these assets in this SPV, so if tomorrow we liquidate them, it's furniture. I mean, what are you going to do? What are you going to recover out of that? Those questions often used to come. I think now they have also formalized a lot of these structural issues in terms of the instrument itself. But how do you, through your vintage, have you already seen some kind of, days past due kind of patterns, or any kind of, investor-led recourse which has happened? Because in your case, because you're also originating, effectively it's your brand also which gets tied to it, right, one way or the other. So they're also piggybacking on that. Okay, Jiraaf must have done a good job, only then I'm gonna piggyback on that. Yeah.
No, so very good question, Nikhil. Because it's one of the things which I would say keeps us awake at night, right? So if
you are one of the very few people who says that something keeps us up at night, because every second person we say, no, you're perfectly fine. I'm like, that doesn't make any sense.
No, I think the only problem we solve for in our business is managing risk, right? And I also say we are in the business of selling risk, right? So when we actually, investors are participating on our platform, it is also our fiduciary responsibility to price risk correctly, right? See, you don't know whether this risk should be priced at 18% or 12%, right? Now, I as the person originating, or let's say we as a subject matter expert as we claim to be, then it is our duty to price that correctly, right? So I think we are in the business of selling risk on the consumer side and managing risk internally and for our customers, right? So I think that's I would say the only critical thing that we do in our business. What we see till date, fortunately, we've not had a single day delay. Today, we've repaid more than 1,000 crores to our investors on the platform. Today, we are in a state where we actually process 2 to 3 repayments a day, so almost 80, 90, 100 repayments a month, right? But we have not, seen that delay. I think first and foremost, the way at least we think about it as a organization is, first step to avoiding default is to do it at the origination step itself, right? So if and that is where we spend most of our time, as I said, on the credit process of ours. And the second is just the DNA thought process. I'm like personally very inspired by, let's say, Kotak as a brand, right? And what I've realized, if you see Kotak, they get the most rich valuations on their AUM, but their AUM has not grown for the last 4-5 years compared to, I would say, at least any other large bank, right? I think the one DNA is you would rather not do a deal than do a bad deal.
Yeah.
And, I think that's the DNA that we also live by. That, for us, whatever whatever commitments we have to our investors, whatever growth targets that we have internally, that aside, if there's something that we are not happy with, in the credit, we will rather not do that transaction, right? So I think that's the first DNA as an organization that we have, right? The second question is more difficult to answer, which is how do you have recourse? I think in India, it's a country. It's very difficult to enforce legal rights, obligations, securities. In the US, it is that much more simpler. While we take everything, all right, all securities, but actually when it goes into enforcement, things become challenging. But I think there are 2-3 things that you do. One is to again ensure that your legal documents are watertight, right? I think that's the first step to it. The second is, you need to, and hence, you are always seeing, you also need to understand for the counterparties, their first priority is banks. Second will be NBFCs, and third will be funds like ourselves or platform, right? While we are still in our growing journey, right? So how do you ensure that you are right up there in their mind when it comes to a stress situation, right? They need to deal with you appropriately with any other financial institution. So you need to have enough things built into structures, into documents, so that they give you that kind of importance, right? So that becomes very important. Finally, see, you need to also take note of things which are practical in terms of enforcement. For example, I'll tell you, you might say that I have an asset, that same question that you said, right? Let's say, you might have furnitures, let's say as security. One part of it is the what value will you get in the secondary market? That's still aside. Let's say you'll get 20% value. The first step to knowing is, can you actually possess that furniture in case of default? Yeah. That furniture is given to maybe 50,000 customers in their individual homes. That might be lying in some corporate office. Are you going to go first, enter that corporate office or barge into that corporate office, go to 50,000 people and recover that furniture, get it in your possession? That is step one to actually realizing value. Right. So I think what we spend a lot of time on is also the practicality of the securities that we take, right? And when
could you like maybe give an example or two in terms of, like you mentioned, the practicality of the security, which gives you some sort of actionability, and the legal structure that you follow in a typical deal?
So, for example, when we, let's say, when we talk about security package and collateral, right? You can tell me that, hey, I have this 5-acre land in Mysore, this is valued at 10 crores, I don't want to take it, right? Sure. That is of no value to me. Right. First, what is the he'll give me a valuation report from a valuer saying this land is worth 5 crores, whatever 10 crores in Mysore. That has no practical value because I don't know, I don't understand Mysore. Whether you can sell a 5-acre land in Mysore, how many buyers will be there to take a 5-acre land in Mysore is of not of value to me. Like I can't attribute any comfort to this kind of security while on paper it exists, right? But on the other hand, for example, if you tell me that here is a residential apartment in Bangalore in this tower, which is worth 5 crores, and I'm pledging that to you in your name, right? Now, that is a far more, it's the same type of security, right? Land and maybe an apartment, but that is something I will attribute.
But it's probably more of an operating asset, right? So that makes
exactly,
it.
Right. So when I know that a 2-3 crore ticket size house in this location in Bangalore or in Mumbai in a tier 1 city, I can, if I have it as my collateral, I can actually go register it in my name. I can create a mortgage which will actually show in a sub-registrar office so that no one can actually sell it tomorrow. And that is of real value to me, and I can actually enforce, liquidate it, sell it to someone if required. Right. So this is a simple, I would say, difference in the same asset type where you will say real estate or whatever, but when is a very liquid security vis-a-vis one which is a liquid one, right? Similar, I would say you can also do even in the let me use furniture as an example again, right? If you give me furniture as a security, I will never accept it. Why? Because furnitures, before again repossessing, first is the ownership identifiable. Yeah. You have, let's say that you can even repossess the asset, but there's a chair lying in a corporate office, which is the chair that you have funded. Is there your name written on it? How do you know that this is the furniture that actually belongs to you? Vis-a-vis when we had when we do leasing, we use like automobiles as a asset class in our leasing portfolio. Why? Because cars have a identified secondary value. You know that a car which has run 50,000 kilometers for 5 years, this make is of this value, 1 lakh kilometer. So it's very, in that sense, there's some science to it. The second part is every car has a RC registration number and an RC card. That RC card will have our name on it, right? And then you can create a hypothecation of that asset in your name as well. So again, while possession risk continues in this, but that is a security that I'm far more willing to take than furniture where, I don't even know, first the condition of that asset will determine a lot of things. Which asset is mine is a question mark for me. Right. So I would say these are practical calls to take when you are accepting security. On paper, it might be anything, but actually, practically, how do you value this asset is very critical. That is what we focus on.
Right. So rather just do unsecured lending and price it up, I guess. One step, right?
That is better rather than taking those kind of
built into the price. Yeah, just because you talked about regulation, like debt mutual funds were sort of, for retailers at least, that was probably the easiest way to get exposure to some kind of fixed income product, right? And I think, was it this year, I think the LTCG benefits also sort of went away, right? Does that have an impact? Does that have an impact, positive impact on sort of investors seeing you as a much more tax efficient way to sort of invest in fixed income products?
Yeah, we are not more tax efficient.
It's the same.
Like the other products became less tax efficient than what it was, right? So, but yeah, I think it will play out over a period of time, right? I think obviously debt mutual funds has seen a lot of inflows over the last few years. Now I think investing directly in debt markets in bonds will become, I would say, more attractive because of the tax parity, right? We will see how this plays out. It makes, I would say, logical sense or intuitive sense that we should see a lot of that benefit coming to, I would say, products in the fixed income category. And then obviously as a platform, we should benefit from that. It's still early days because, most of the allocation for the last financial year, people have done it in a jiffy in the last 15 days of March. So they've kind of, I would say, invested before time, maybe for the next 3-4 months liquidity that they would have had. So I think a lot of these benefits should start showing up in the near term 1 to 2 year horizon. I would believe so that, this should give a good, I would say, impetus to the rest of the debt markets. But let's see how that plays out.
And on the borrowers, right, since working capital is one big piece and, invoice discounting, RBF, whatever it is, one good thing is like those problems don't get solved by just one round of borrowing. They keep coming back, right? And I guess that's where some of your scale benefits are. Like all the due diligence that you've done and sort of built the models, they need not be done for every issuer. They need not be done again for the same issuer, right? So how many of those, roughly, I guess there's a trust, intuition tells me that there's a lot of repeat borrowers who sort of are just doing it over and over again, right? I mean, is that a trend?
Especially in working capital, no, and if you are a frequent user of the platform, or anyone who's a frequent user of the platform, optically gets that sense. But the way actually it works is we sanction a limit to a borrower for a period of time, especially in working capital. Let's say we'll sanction the 25 crore limit and say that this limit is, is 1 year valid, right? That means for the next 12 months, I'm happy to take a 25 crore exposure with you. Because this is typically a 30, 60, 90-day requirement, they will repay when they collect the funds from their business and they repay us. So even if I have a 25 crore exposure and that company repays tomorrow, that exposure will, let's say, come down to 20 crores. Now there is again a 5 crore limit that the company has and they can borrow again, right? So in that sense, yes, that repeat is there, but we have given them a 1 year validity. Because in this 1 year, what we do is we do basic credit monitoring. And basic is also quite stringent. But when I say basic in the sense, I will go through their MISs, I will check for a few key trigger points that I want to monitor in their business, like is their revenue still growing, debt is not, getting loaded, etc. So there are a few things that have become critical, but I don't do a very detailed assessment. After the end of 1 year, I will redo a very detailed assessment, almost like a fresh proposal, and then see whether I want to sanction them that limit for 1 year again or not. So in this interim, but yes, the transactions are frequent because of the short tenure of it. But this is only again for working capital. If you go to the other products that we have, which are more longer tenure, there because you are giving them a one-time dispersal and the sanctions are longer, so you will not see that repeat, that often, right? So that's that.
And how's the repayment typically structured for the other product? Is it sort of something back on day zero as a platform fee or such, and then it's sort of segregated over a period of, let's say, a 1 year product? Is that how it sort of works, principal plus interest payback, or are there some interest holidays or moratoriums? Like, is it deal by deal? How do you sort of think about that?
Yeah, so typically every deal is structured and is customized. So typically what we like to do is, again, we have two things to look at over here. One is that what are the risks that the company has as an underlying business. So let's say that we find, this company, we are not very comfortable taking a 12-18 month view, but the company really wants 12-18 month money, right? Mm-hmm. So then how to balance it? We say that while we'll give you 12-18 month money, but it will be monthly amortizing. That means you will give me a repayment every month. So the exposure to that company keeps reducing. And after month 10, month 11, you'll see that only 10, 15, 20% of your overall exposure is actually still to be repaid. So for that exposure, I'm okay to go till month 12, with the company, right? So this is a part of risk, also the structuring part. The second is the company's underlying cash flows become important. See, let's say it's very easy to understand in an NBFC situation. NBFC which is giving gold loans. Typical gold loan tenures are 12 months, 24 months. Actually, it can go from 6 months to, let's say, 12 months, 24 months. If you are doing these unsecured personal loans, which is the flavor of the season, typical tenures are 3 months to 6 months, right? Very, very short tenure. The third is if you are doing the automobile loans, like two-wheeler financing, three-wheeler financing, typical loans are 2 years to 3 years, right? Now, when I'm giving to a respective NBFC, I need to see how his underlying cash flows are and whether he will be able to repay, without causing any stress to the company itself. So if I'm doing an unsecured loan NBFC, I'm very happy to do a 12-month financing. But if I'm going to give money to a two-wheeler, three-wheeler NBFC, I rather give them 2 year, 3 year money because then the ALM is kind of aligned, right? Yeah. So a lot of these factors come in to decide what the tenure should be. So and the company's financial health, strength, am I comfortable taking that kind of a tenure view with the company? So it's a multiple of these things, but so hence everything is customized, and there is no one rule fits for all, for us in that sense.
One thing that you mentioned obviously was that on the investor end, your minimum check size is like 1 lakh, which obviously gives access to a fair bunch of people, right? But on the other end, there is a narrative around, why fractionalization on fixed income through technology, kind of make it as small as like a rupee or 500 rupees or whatever, right? I mean, there's a lot of kind of conversation around that. And I was just wondering, effectively by being an originator, there is obviously there's only a finite amount of transactions that one can, because there's a fair amount of heavy lifting that's required on the DD end and on the issuance end, right? So is there a view that maybe in the future, deals which are probably originated by third parties, you do your second level DD and then you provide a fractionalized exposure through, I don't know, blockchain or through some sort of a tech layer to your investors? Is that also something that you want to look at some stage, or it's going to be always like, like a primary issuance where you have end-to-end control?
Right. Yeah, I think that's these. I would say these are things that we keep as a startup. We live for experimenting, right, and seeing what can we do differently, and what might be a better structure, etc. Right. So I think we've kind of thought about this, right. So two things over here for us. I think at least for the near, again, till medium future, we don't see that our ability to originate will be challenging, right? So I think for the first few years of our journey, we are, today just north of 2 years old. But I would say for the at least next 3, 4, 5 years, for us, it's a more demand side challenge to solve for, because we are in that phase where we are still developing trust and credibility with our customers. So while that is, I would say, not yet there, or not, it's not like, we are the go-to platform for fixed income in the country. We are not there yet, right? So till we are in that journey, for us, demand, which is side of a business, which is, finding investors to invest on a platform, that is the, trickier thing to solve for rather than the origination side, right? So while that is not the problem, long term, yes, origination will become a problem. If we get to a $4-5 billion AUM, can we originate high quality credit at that volume to serve all the people that we have, we have on a customer? So maybe long term, then we go down to that path where we are just, as you said, there is some primary originator, we do a second level of DD, and then, we take it onto a platform, right? So that's a more long term view. We don't see that as a thing to solve for the next few years. Then the second part of this question is also fractionalizing, right?
Yeah.
Like, you can fractionalize it to no extent, right? You can, like we do 1 lakh, you can do 10,000, 1,000, 110 rupees, right? There is no end to fractionalizing. I think at some stage, right, what we want to ensure is that the people are investing in a product with the right intent. And what I mean is, once it becomes 500 rupees and 1,000 rupees, you will not even bother reading 2 lines. You will just say that, yeah, Jiraaf ne bola hai, kisi ne bola hai, might as, 500,000 rupees, I'm good to invest. Right? Already there is a problem that we have to solve as a fixed income platform, that in India, people think fixed income is guaranteed income, right? So there's a difference between, certainty to guaranteed, right? So, or predictability to guaranteed, right? So that is already a problem. So we really want customers, when they come onto our platform,
to be committed,
spend some time in reading, understanding the product, what are the risks, and then making a conscious choice. So the higher the investment amount is, the more the customer is likely to spend time in all of these activities. The small and the lesser the investment amount is, people will just be investing in 2 seconds, right? And that's where the balance for us is to draw. So that's why I said we spend a lot of time upfront in awareness and education, and then reduce the investment side rather than doing the reverse. So that's.
But I thought like mutual funds are guaranteed, no? That's what I keep on hearing, no? That mutual funds are guaranteed, no?
Yeah.
Yeah. At least that's how the bank RMs talk.
Yeah.
And in fixed income retail investors, right, they often, it's a common mistake. They see the word predictable, and they almost always associate it with guaranteed. Predictable, I'm predicting I'll get back, so it's guaranteed. But obviously, there's a difference between recurring cash flows. Anyway, on fundraise, right? Listen, at the end of the day, you're underwriting. Sure, you're sort of got guys that you're helping in terms of allowing them an investing angle. What does the future look like in terms of building the book further and distributing more loans, right? Obviously, there's a group of people who are sort of giving you money and they're using it as a platform to make fixed income investment decisions. But is there an appetite to sort of raise wholesale debt and sort of start doing it at that level as well, and sort of become almost like a debt investor of sort? Is that something you think about, or because I know you've raised equity money, right? And you said asset liability mismatch. At some point, underwriters have to stop underwriting from equity and move to wholesale debt, and we're seeing that in startup underwriters as well, right? You're obviously different, but how do you see about that of going the book?
Yeah. So I think the way we think about it is right. I think the beauty of our own business model lies in its unit economics, which I have told a lot of VC investors. Obviously, not everyone buys it, right? But and the reason is because for us to grow, we are not actually dependent on capital raising, right? Because we are a curated marketplace, right? So we don't invest our own money. So effectively, we can grow our book, our AUM, without having our own capital. With wholesale debt, there are two things that come in, right? Once you do that, you need to keep raising capital to grow. The other is your cost of leverage or debt is a deterrent to the kind of opportunities that you do. For example, if you're borrowing debt money and then reinvesting, what a typical NBFC does, and let's say an NBFC is borrowing at 12% or 13%, then that NBFC's cost of borrowing is then determining what transactions that NBFC can participate. Because that means they can only participate in 15, 16 plus seats. They can't do lower. Right? But if you see our platform, we have a 6-7% offering, we have a 8-9% offering, and we have a 17-18% offering. The reason it's so diverse is because we don't have an inherent cost of capital. Right? So I think those two things. We like the, I would say, the platform play. I think it gives us more diversity. It gives our users more diversity. Second is that once you start investing from your own book and in wholesale lending, then it's become very capital heavy, and that's not what something like. We think that the beauty of this business is in it being a platform.
Right. No, but if one has to be like a kind of devil's advocate, the angle is also that platforms never have a long-term skin in the game, right? And cost actually brings inherent discipline also to how you lend. How would you counter that?
Yeah, no, it's again a great question. I think it's easier said than done, right? As I mentioned, that once we have some balance sheet capital, one thing we definitely want to do is that we want to at least have our own skin in the game, right? Now, whether that means that at least 2%, 5%, maybe 10%, depending on our own capital, we will invest in every opportunity and hold to maturity in every opportunity, right? Finally, if we tell our customers that, we believe in the credit of these companies and hence they are on the platform, we also need to have our money where our mouth is, right? So the idea is to have some skin in the game. And the skin in the game, for example, as I mentioned, that can be it's not big, doesn't make us capital heavy. Like if I even put 5% of the book, that means for any X AUM, I need to have 5% of my own capital, right? So that is far more manageable. So the idea is, this is for two reasons. I don't think it's more for our own discipline. It is only for enabling more customer confidence, right? So today, customers, we can at least tell our customers that, we've done the hard work. We are also putting in our own money, and, that will add to consumer confidence. I think from a credit perspective and discipline, I think that's just the DNA and culture that we need to build as an organization. And, that comes from top down. That's what we focus on in the last 2 years. I hope that continues for the long run. That will determine our long-term success. So I think that is more DNA culture. I don't think having your own money, there are enough NBFCs and banks with their own money or customer capital that have gone bust, and then there are enough that have been successful, right? So I think investing your own money does not change that. So I think it's more DNA and culture.
Because it's also not their money; it's someone else's money all the time.
Yeah, absolutely.
Nothing. So stay away from anything that increases the cost of capital, essentially, right?
Yeah, absolutely.
Last question, Saurav. Effectively, like you were quite disdainful about personal loans being the flavor of the year. So obviously that you're not a fan there. But when it comes to SME underwriting, it's by default, there is a manual element there, right? It's unavoidable. And you need feet on the street. You need guys to look at books. You need to take those subjective calls to underwrite. Not the classic VC story. But you have managed to raise a fair bit of VC capital as well, right? I think you have raised around 10 mil to date. Last round was around 7.5 mil. You have Axel on your cap table, so a marquee fund. How difficult or easy was it to kind of pitch this as a angle, or was there some level of investor education that was required? Probably, if you pitch something like this today, it would resonate way more than probably a year back, because now the ecosystem is also moved. But how was it for you?
Yeah, no, it was challenging, right? I think fundraisers are in general difficult because the conviction that you have, the kind of, I would say, time you have spent in your own business. External VC never spends that much amount of time, right? They'll have one call, few calls, many calls, let's say. but that's limited, right? So it's very hard to, I would say, communicate everything that you believe in to someone else, and hence fundraising is always difficult. I think in our case, right, like the key question which we always get asked is exactly this thing that if you have to get to 20,000 crores, or let's say 3, 4, $5 billion, like can you find so many companies? And
Sharad is about to draw a hockey stick, I think, hypothetically.
Yeah, right. Absolutely.
What about this?
VC's favorite
word, the hockey, the J curve, or the hockey stick, right? Yeah. So they're like, can you, like, are there so many companies in India looking for capital, and why will they favor you over a bank or a traditional institution, and etc. Right? So I think as you mentioned, so that's always been the hard question to answer. I think just what in VC language, what they understand is statistics, right? So like India as a country has one of the least corporate debt to GDPs, right? With a lot of the other mature economies. So he felt that there are the need for alternate capital providers in India, and and hence that's also a fundamental problem that is solving. So the idea, there are enough and more companies, and there is a lot of play for any kind of alternate capital provider, whether that's a fund, it's a platform like ours, new age NBFCs. There are multiple ways. But yeah, I think people who understand the credit business well get it. Otherwise it's a leap of faith. Otherwise, quite difficult.
With all this hockey stick chasing, I mean, VC's VC ecosystem is quite sharp and quite strong, but in pursuit of the J curve, there's so many businesses with no EBITDA, no paths to even EBITDA profitability, right? So, and that's why I think the old school core business of actually underwriting and actually doing the work of finding out who the borrower is and doing the channel checks like you do, that screens of cash flow generation and profitability.
I remember this VC telling me after, he's like, what do you do on the supply side? After I told him, he's like, you are effectively doing what we do, right? Just that we invest equity in startups and you're investing, or you're giving debt. I was like, I would say, you can broadly correlate, but I think we would be doing a better job.
उनसे पूछना चाहिए, उनसे we should ask, आपका reports क्या है? But it was great chatting and learning about your business. Like, obviously, it's very interesting, and we get a lot of fintech companies. We've looked at a lot of guys who underwrite and sort of issue small ticket size loans, but this is obviously sort of a very different platform and matchmaking kind of an angle, which is solving a real new asset class for retail investors, right? So it was fascinating to hear you speak about it, and unsurprisingly, it requires a lot of it's more art than science, and there is a lot of actual wearing the banking hat and doing the work. So that's what makes it quite interesting for us.
So same here. Thank you for having me, Nikhil and Sharad. Great chatting, and look forward to hearing to your podcast.
No, absolutely no. Thanks a lot, Saurav. We'll be obviously tracking your business and wish you all the best for bigger and better milestones. And yeah, with that, this is Nikhil Arora, and with me is Sharad Tupran signing off.